So when I went to Dubai, I had a lot of commitments at home. So that time I only used to keep whatever is required for my expenses. Rest all I used to send to my family. Initial years, I was not too much into investment. My equity exposure was little less. Till 2010, I was mainly into real estate. 40% roughly is in mutual funds and the 60% is in, I shifted all my mutual funds to direct scheme. If I combine all of my asset classes, my net worth probably is around
Hi Jaideep, welcome to Power Pioneers. Let's get started with your early journey and your career.
I'm basically from Delhi. So I'm an electronics graduate. 91 is when I did my graduation from Delhi University. For a post-graduation, I was still, doing a bit of certifications, still figuring out what I'll do, very small jobs in between. 97 is when I first got a proper break into IT industry. So there used to be a company called NIT Technologies in Delhi that time. My package was 7 LPA. I was a Visual Basic developer, started my career then. Then I went to Dubai and Singapore. It rose to 25 lakh per annum. Then when I came to Wipro, 2006, 12 LPA per annum. Then I went to UK. I think if you see the UK, the pound and all that, I think roughly 30-40 lakh per annum. Then when I joined the oil and gas major in 2015, they offered me 50 plus LPA, approximately 55. And it has grown since then roughly 20-25% till date. So that's my journey career wise.
Got it.
That's how
Very
it is.
interesting. Would love to, cover all of these phases, right? The first 9 years where you had a lot of international exposure,
Yes.
and then the next 9 years settling into Bangalore.
Yes.
And now this is your third 9th year
Yes.
stint, right? So
Yes.
would love to double click on all of
Yeah,
these. Let's
yeah.
start with, the early phase. How did your money or your investments increase along
Yeah.
that way? Because usually it helps in someone's financial journey to work
True.
a couple of years abroad.
Yes.
What's your take?
So when I went to Dubai, that's where I had a lot of commitments at home. So that time I only used to keep whatever is required for my expenses. Rest all I used to send to my family.
Okay.
So that way, my initial years, I was not too much into investment. When I went to Singapore, that's where I had some spare cash or you can say capital. So it was primarily a FD driven investment.
Okay.
When I switched my second job, that's where I came to Bangalore. I went and invested in my first property in early 2006 to 10.
Okay.
So the transition happened from fixed deposits to real estate.
That was for investment. the
For
property.
yeah. In 2006, I came back to Bangalore. I was very clear that I don't want to stay in a rented house. So
Okay.
I stayed in rent for 1 year.
Okay.
And I booked my house where I'm currently staying.
Okay.
So that was my first property investment. But I mean, I should not call it investment because
Yeah.
it's for my own staying. But when I was in UK from the same company,
Okay.
then I invested in Bangalore in one of the property in Electronic City. So that was my first, you can say, a big investment other than FDs.
Okay.
So bought a second property in Bangalore, which is still there. By then, I had started to have some exposure, but the challenge with me was because I was abroad, so I was not getting too much of exposure of Indian equities or demat accounts and all these things. So that's why my equity exposure was little less.
Okay.
Till 2010 or 20 early, I was mainly into real estate.
Okay.
So that was my second phase. So first phase, FD driven. Second phase came into real estate investment
Okay.
and opened demat account just to explore and play around.
Okay.
When the third phase of my career started, which is 2015, when I joined my third company, which is oil and gas major, I must say that's where my proper or real transition started to happen. So I increased my exposure to equity.
Okay.
Here, I would like to add retirement. I was very clear from my early days. So
Okay.
so 2015 onwards, what I have been doing is my DEP. I am availing all the products which are there.
Okay.
PPF I fully load on first week of April.
Okay.
NPS, when NPS was first launched, I think 2006, 2007. I remember I got it open that time.
Okay.
So NPS is something which I'm investing off late, and the provident fund is anyway there. So I am fully loaded on the debt side. So in the third phase, my retirement corpus was building. And then I started slowly investing into the direct equity.
Okay.
So I have always taken a bit of direct equity and mutual fund as the route.
Okay.
But that exposure was very small in 2015 onwards for that time, which actually took a very steep increase when the COVID hit. I literally invested in direct equity, whatever my capability that time was. And that gave me a very good insight when I saw that, grow. That in next few years. So that's my journey of 3 phases.
Got it.
Yeah.
Very interesting. And so that's a mix of a lot of asset classes,
Yes.
right? So as on today, what is your portfolio and how does the allocation look like across all of these?
Yeah, good question. So if I combine all of my asset classes, okay, so my net worth probably is around 6.5 to 7. That is what CR is my corpus. And it is very evenly lit across. It is 33% in my debt fund, which is all my PFs and PPFs and NPS. The value of all my real estate is another 1/3.
Okay.
And 1/3 is mutual fund and equities. So it's a very evenly balanced 33% each in real estate debt instrument, which is retirement corpus, and 33% in mutual fund and direct equity.
Got it. I would like to double click on each of these 1/3,
Sure,
right?
sure.
You mentioned your PPF, NPS in your debt component.
Yes. Yes.
Do you not invest in FDs anymore?
No, now I don't invest in FDs anymore. Okay. So my debt instruments are going non-stop.
Okay.
In fact, I have added the voluntary PF also, because as you get into the late 50s or mid 50s, I think personally for me, I want to make sure that I have a decent retirement corpus. So I'm continuously investing in all these classes. Other than FD, recently I have explored something called government security bonds.
Okay.
So that is something which I'm exploring.
Okay.
That what are the differences and plus and minus between FD and government security bonds.
Okay.
As of today, I feel that maybe government security bonds pay a little less in terms of interest, but I found them very safe compared to FD. So I'm seriously considering adding a lot more government securities bond into my portfolio, because now I want to protect my capital also. While equity exposure will continue, I will add more of a government security bonds also gradually. So that's how it is.
Got it. Given that we are discussing about debt, if you could, help our audience understand what are government securities and, what are the benefits of, having that in your portfolio?
So based on my understanding, they are very, very safe. They may not look attractive in terms of interest rate. I mean, those who are probably in their early career, age group, probably this is not the instrument for them.
Okay.
I'm talking about those who really want to now protect their capital.
Okay.
They can seriously consider government bonds. So there are few categories in that. One which is called T-bills. T-bills is something which is less than 1 year. Very safe. They will give you interest upfront. And then you will get your capital back depending on the duration. So T-bills comes in 3 categories: 91 days, 182 days, and 364 days.
Okay. And what are the return range? Typically?
6.4, 6.5. That is how they are. As I said, interest is definitely less than FDs. But when it comes to assurance and security, these bonds are very safe. And then the other category is, as I said, corporate government bonds. They come for a very long-term duration.
Got it. No, thank you for sharing. I think bonds are less talked about. Maybe they are not as
and I think people don't get that maybe
thrill
commissions or that's why nobody actually talks about that.
Yeah.
And as of today, probably the liquidity is less.
Okay.
But now government wants retail investor to directly invest. For example, the face value is 100 rupees or 1,000 rupees. So you can actually trade these and it goes up 102, 103, 105. So these are actually tradable bonds.
Oh, okay. So for my understanding, like if you are taking a bond that's 10 years tenure,
yes,
I can still sell it on the on the exchange.
Exactly. So if let's say, and bonds and interest rates are inversely proportional, right? So if let's say tomorrow interest rate starts to go down, definitely more people will look for these bonds. So the value, that 100 will go up. And again, it depends on the interest rate cycle. So there is a risk there.
So it's like stock trading.
It's like stock.
Yeah.
Right now, liquidity is a bit comparatively less.
Okay.
All this while, it was only HNIs and trusts which were allowed to invest. But now government has opened it for retail investor also.
I think these sound very interesting. Is there any risk associated with government bonds?
First of all, from the safety point of view, as I said, these are much safer bonds. But the risk one, as I mentioned, that these bonds and interest rates, these are inversely proportional to each other. And because these bonds are there for long, like, multi-decades. So if tomorrow, let's say interest rates again starts to go up, then the bond value will decrease.
No, that is super helpful. And of course, the liquidity part, right?
Exactly.
The ease of getting it.
It is still not those that liquid. And just wanted to add one more thing here. As I mentioned, that there are within bonds, one is central government bond, one is state government bond. Typically, state government bonds pay a little extra interest.
Okay.
I will not say they are risky, but because they are state bonds compared to central government, although it has never happened, but central bonds are comparatively more safer. But till date, it has never happened. Like, government of India defaulting on a bond is almost unlikely. So these are very safe bonds.
Got it. And what's the range of returns here? Like for the T-bills, it's 6.5%.
Yeah. The longer the tenure, obviously the better the rate. As of now, I have seen them 7.1, 7.02 kind of rates. But then if let's say tomorrow interest rates falls down, your bond yield will get better.
Got it.
That's how it is.
Great. Thanks for sharing that. Now let's move to part 2 of your portfolio, which is real estate, right? And it's quite debatable topic. But as you mentioned, right, the first house you purchased, that was for consumption.
Correct.
Is that included in your portfolio?
As of today, yes.
Okay.
Ideally, one should take it out when you do net worth. My first house was taken on house loan. Okay.
The one that you're living in.
Where I'm living in. So I'm a person who feel very uncomfortable when I have any kind of a commitment or EMI to pay. And when I was in UK, in fact, I was settling my loan from UK. So I was very clear that I want to get rid of this loan. I think it was a 20-year loan which I closed in 5-6 years. And the second 2 properties which I bought, they are absolutely zero home loans. So I
paid upfront for the entire.
So they give you a year or a 1.5 year payment schedule.
Okay.
So I've been paying them directly. I don't feel comfortable with EMIs and home loans, actually.
So fair. I think whatever gives peace of mind. I think that's the purpose of money, right? To give you peace of mind. So whatever suits. Like, very interested in the other 2 properties that you bought for solely for investment, right?
Yes.
Want to understand what these properties are, what are the kind of yield that you are getting. Could you share more on that?
So, as I said, these properties were purely for investment and rental yields. That's why my second property, which I bought in Electronic City.
Okay.
So, it's already rented. So it's
a 2 BHK. Residential property.
Yeah, it's a proper residential apartment. I think rental yield is almost 5% is what I'm getting, which is quite okay. And obviously, it appreciates with time. And my second property is still under construction.
So is there like any framework, any checklist that you have to how to assess a real estate property?
See, first thing, as I mentioned, I rely on the builders. Okay. Like, for example, if you don't understand, what equity to buy, maybe, take something in Nifty 50 or so. So that is the approach I have taken here. So because the builders are premium, the chances of doing something wrong or defaulting, I'm not saying is negligible, but that reduces. So the 2 key parameters I go for typically A-class builder and area which is closer to the hubs or the IT kind of cities.
Got it. And very curious, right? I think around the second property you were still into real estate, but around the third you were also having exposure into equities.
Yes.
Right? And comparing this 5% yield versus much higher returns, what made you think about buying another property?
I think my property is something, every time I say this is my last one, and then I end up, taking one more. So again, stable passive income was something which was there in my mind.
Okay.
Although equity would have given me any day a better return, but then equity comes with its own ups and downs. So the reason was I thought that the value of the property will appreciate, and second, more building towards the passive income, which was the driving factor.
So Jaideep, let's move to the part 3 of the portfolio, which is equity.
Yeah.
And equity, maybe you have mutual funds and direct equity.
Yeah.
So what's your allocation across these two?
Yeah. So mutual fund and direct equity, I'll say that 40% roughly is in mutual funds,
Okay.
and the 60% is in direct equity.
Okay.
Just wanted to highlight one thing that I realized this late, that investing in direct mutual fund ultimately gives you a edge in terms of expense ratio. So I was actually initially doing with the same demat account, like where I used to do my direct equity, same I used to buy mutual fund from there. And obviously all these so-called full service providers, they only give regular mutual fund. All my initial mutual fund investment were in regular schemes.
Okay.
But then when I read about this, that direct equity gives you a little bit of approximately 1% delta. So I shifted all my mutual funds to direct scheme. And if I have to talk about what is my approach for mutual fund investment, I only take one from each category. So for example, I have only 4 funds in my portfolio where I invest. I have some legacy which are compounding. It's okay to leave them there. So 4 active funds, 1 from large cap, 1 I have taken flexi cap.
Okay.
So because advantage is that flexi cap can decide, these sectors where they want to move. And then 1 I have mid cap. And then 1 I have international exposure, like NASDAQ or some of these. So these are the 4 funds which I invest.
And then within category also, take let's say large cap for example, right? Now even then there are multiple schemes.
Yeah.
So how do you select the right scheme?
See, usually I look at the AUM, how much AUM they have. I mean, if you will take the ratings, although I know past performance, they say, right, it does not guarantee. But I have taken, let's say, HDFC, the large cap. And then I have Parak or Quant mutual fund. So that's how one each in each category I have taken. So I know past performance does not matter. I don't go by blindly the stars, but depending on the AUM, and a bit of their performance, how they are doing.
Understood.
Yeah.
Interesting. And let's talk about direct equity.
Yeah.
I think your sort of venture into direct equity is also fairly recent.
Yes.
So one, how did you learn about this? And then what is your approach to direct stock picking?
Yeah. So I used to casually watch the money control, right? And in right hand side they used to show, and till date they show the stocks which has fallen and the stock which are gained the most.
Yeah.
So I always get attracted to a Nifty 50, the most fallen stock.
Okay.
So I am by nature a contrarian buyer. Okay. So I buy, first of all, stocks which are part of Nifty 500 universe. So that's where I protect myself from, going into names which you don't rely on. And then if a stock falls, I feel happy. Only thing what I have done, I have now tried to automate this whole flow with a systematic investment. So what I do, rather than a manual approach, now I have added a few signals and same thing continues, but now in an automated manner. So I do that contrarian buy, and the advantage this systematic investment has done, it has taught me when to sell the stocks.
Okay.
I was very poor in selling stocks, but now with the systematic investment, that's the things which I'm able to at least correct a little bit, or I can say I'm in a right track.
Got it.
Now these signals tells me that if a stock which is peaked, let's say if something which has gone way beyond its 200 moving average, and that stocks is turning down, so I book my profit there and I invest in something which is beaten up and which is about to go up.
Okay.
So like this cycle continues, and I'm now doing it with no emotions.
Okay.
So that's the approach I have taken.
Got it. Very interesting. Could you talk a little bit more about this automation? Like how have you automated this entire system?
Sure. So what I do broadly, so I take the flat files, like, NSE website, they give daily, end of the day, many data, like, delivery percentage of every stock, their open, high, low, their volume, all these data is available on Nifty. For example, Yahoo Finance, one can download these data in flat files. I upload it into my database, which is a MySQL database, but one can do it in any database. Then there are some, some procedures which runs, and daily at the end of the day, I have a complete overview which stock is doing what in terms of price, in terms of volume, in terms of their relative strength. In fact, I have digitized the candles also.
Oh, okay.
So for example, I can literally query and I can say, show me all the stocks in Nifty where the tail was maximum. So it will give me all those stocks, so candle is all digitized, volume, RSI. So these are like a building blocks for me. So all these are available in my database.
Okay.
I have to just merge these with each other. So for example, stock which is high volume and the tail is longest. That means there are a lot of buyers there. So I can actually create my own queries and I can come up with these queries at any given point of time. So I run these store procedures and it is evolving. I started with only price data, then added volume, then added the delivery percentage, now RSI. Now I'm in fact bringing some of the global indexes also in the database so that I can see how NASDAQ and oil price and dollar index is doing. So it is actually evolving, but it actually helps me seeing what data is saying, because typically we struggle. If you see our portfolio, right? What portfolio tells us what is my gain profit percentage as of today. But this view actually helps me to see where stocks are in terms of their moving averages.
Right.
What is price volume doing underneath that? How is their candle doing? So that way it gives me a very different perspective to actually shortlist and invest and sell these stocks.
Got it. Very interesting. And since a lot of this is around charting and, and the visual representation, is it more short term? Like,
no. See, although these charts are much more sophisticated, like, one can argue that there are so many screeners. Why are you building that? Take example, charts. So the challenge there is you have to go one by one. You have to see one chart at a time. But what advantage I have, I can run these queries like a SQL, and it can fetch me and give me all that across the Nifty universe. So this investment helps me in long term.
Okay.
Because, I can book part profit. I know when to add something more. So it is helping me with the long term. Although if I tweak it, I can make it for my momentum investment also.
Cool. So this entire automation, right? It seems little technically advanced. So do you think it's recommended for retail investors?
Yeah. See, first of all, I'll not say that it's a showstopper. Definitely it added or it gives you an edge. But let's say if somebody don't use that, will they struggle? Answer is no. If you see my approach, it is literally a contrarian approach. It can still be done manually, right? Look for stocks which are beaten up. If they are fundamentally good company, just buy it. What this whole automation is helping me is just taking the emotions out. So to answer your question, I don't think so it's a showstopper, but definitely knowing these things will give you a slight edge. Today there are, let's say, thousands or lakhs of people. So these things will give you a little bit of edge that it will elevate you from that crowd. And it is not that one has to literally build the way. Like for example, today Excel also can give you, these averages and moving averages and all that. So there are many ways. So I'll say knowing the data and what is happening underneath always helps.
Got it. And you learned it yourself along the way.
So my learning was continuous. One has to spend a little bit time and a little bit of passion. I think these two combined together, it will work for retailers.
Got it. Great. I would always ask, people who have achieved financial freedom or are close to it and, build such good corpus. What's your approach on life beyond being FI and not fired? And how do you look at that corpus today?
So I must say that my corpus number is shifting. Few years back, I thought the corpus which I had will be good enough. But now I'm of the opinion, no, let us add a little bit more. So what my message to your audience will be, keep doing what you are good at. So if you are good at job, you are enjoying, absolutely enjoy that. But make sure that you invest accordingly into any of these assets. If one cannot understand or it is too much time, I think mutual funds or index funds is good enough. But stay invested is my mantra.
Great. I think this has been super nice talking to you, and I had such a great time. Thank you so much, Jaideep, for taking out the time.
Thank you very much.